Hi, in this video, we will be learning about accounting definition, account types, and rules of accounting. Before we go into the topic of rules of accounting, let us understand accounting definition first. So this is the accounting definition which we are seeing on the screen in the first point. It says, accounting is the process of recording, classifying, summarizing, and interpreting financial transactions to provide useful information for decision making. This is accounting definition. In accounting, we not only record the transactions, but also we analyze the data which has been recorded to take decisions. So first term is recording. Let us understand recording. Recording means documenting or entering the data of all types of financial transactions like sales, purchases, expenses and incomes. So in simple terms, recording means entering the financial transactions into books of accounts. So to record the transactions in books of accounts, we need to follow golden rules of accounting. After we understand the accounting definition, we will next dive into the concept of golden rules of accounting. In this slide, we have understood that recording in accounting means entering the financial transactions in books of accounts by applying the golden rules of accounting. This is called as recording. Let us understand classifying. Classifying is the process of organizing financial transactions into categories or groups based on their nature. For example, all the transactions related to an asset will get grouped under into a separate asset account, and all the transactions related to liability will get stored in a separate liability account, and all the transactions related to a separate expense will get grouped into a separate expense account. All the transactions related to income will get grouped into a separate income account. Let us understand this classifying with an example. For example, let us take expenses. In expenses, we have three different types of expenses in our organization: rent, petrol, and internet. These are the expenses which we incur regularly. Rent, we need to pay it every month, and petrol expenditure is being incurred twice in a week, thrice in a week, as per the requirement. And internet also, we need to pay it on regular basis every month. So for these three types of expenses, we will maintain a separate accounts for each and every expense, like rent account, petrol account and internet account. Each and every month expense of 10,000 incurred on rent will get stored in a rent account. The expense incurred on petrol each time should be recorded in petrol expense account, and every month internet expense which will be posted into internet expense account. This is called as classifying. That means by this example we have understood that classifying means we store the transactions in separate accounts based on their nature. This is called as classifying. And the next term used in accounting is summarizing. The point which you see on the screen is summarizing. Summarizing is a process which helps in preparing financial statements like income statement and balance sheet by arranging the financial information in an understandable way. In simple words, summarizing means combining the accounts based on the account types to prepare financial statements. For example, in financial statements, we have two financial statements, balance sheet and income statement. Income statement is also called as profit and loss account. So to prepare profit and loss account, we need to arrange or group some of the accounts based on their nature. So to prepare profit and loss account, we need to organize all the expense accounts to the left hand side of the profit and loss account to show the total expenses. And also we place all the income related accounts to the right hand side of the profit and loss account to show the total incomes. So this is called as summarizing, where we group all the expense related accounts to the left hand side and group all the income related accounts to the right hand side of the profit and loss account. This is called as summarizing. And the next is balance sheet. So in balance sheet, here also we do the summarizing. In the same way, we prepare the balance sheet by grouping all the liabilities account onto the left hand side of the balance sheet statement to show the total liabilities. And we group all asset related accounts to the right hand side of the balance sheet to show the total assets. This is called as summarizing. And the next word is interpreting. This is the last word. Interpreting in accounting means looking at financial statements like balance sheet or profit and loss account and understand what it really means. It's about figuring out how well a company is doing financially by analyzing things like profits, expenses, and debts. This helps people make decisions like whether to invest in a company or purchase an asset or give a loan. So, interpreting means analyzing the financial reports based on some financial ratios. And this analyzing process is done by professionals like cost and management accountants, CMAs, or chartered accountants and data analyst persons. So now we have understood 4 terms used in accounting definition: recording, classifying, summarizing, and interpreting. So this is called as accounting definition. In this slide, we will learn about accounting and bookkeeping. So here we have the definition of accounting. This is what we have understood in the previous slides, the 4 terms used in accounting definition: recording, classifying, summarizing, and interpreting. This is called a group of all the activities in the accounting. And bookkeeping. Bookkeeping is the process of recording day-to-day transactions in a systematic manner. So in simple words, the meaning of bookkeeping is a process of entering the financial transactions into books of accounts by applying the rules of accounting. So the first step in accounting is recording. Recording is nothing but bookkeeping. So now we will understand the difference between accounting and bookkeeping. Bookkeeping records financial data of company's earnings and expenses. And accounting uses information collected in bookkeeping to help a company make financial decisions. So by these statements, we can understand that the process of accounting starts after the bookkeeping ends. So now we will get into the account types and rules of accounting. The first step in accounting is to record the financial transactions. So to record the financial transactions in books of accounts, we need to apply rules of accounting to 4 different types of accounts. So what is account types? Now we need to understand first what are the account types before we go into the topic of rules of accounting. In accounting, there are 4 different account types. Those are assets, liabilities, expenses, and incomes. All the accounts which are created in accounting will come under any one account type out of these 4 account types. So now let us understand these 4 account types first. Let us understand assets in the first place. An asset is anything a business owns or should have a monetary value. An asset must be owned or controlled by the business and provide economic benefit now or later. In simple words, assets are those which are purchased by company to use in its normal course of business for earning profits. Let us take some examples to understand assets. Some of the examples of assets are cash, inventory, building, machinery and equipments, and vehicles. So these are all assets which we use in the business. We don't sell these: building, machinery, equipment, vehicles. Inventory, yes, we sell, but that is a current asset. Cash is a current asset. For example, we have purchased a building for office purpose to run the business activities, or we purchased a building which has shops in the ground floor to sell the goods. That means we are using this building to generate the profits. So this becomes an asset. In the same way, we purchased a machinery to manufacture goods. So the machinery which we purchase is owned by our company, and this becomes an asset. And car. We purchased a car for the purpose of commuting our company employees from office to their home and from home to their office. This means we are using this car to run our business, and this car becomes an asset for us. In the same way, cash. Cash is also an asset because cash which belongs to our company is an asset and can be used to purchase an asset or to pay for any expenses like rent or petrol. Inventory is an asset because it is owned by our company and can be sold to our customers. So these are all assets. So now we have understood what is assets. And the next concept is liabilities. Let us understand liabilities. Liabilities are debts or obligations a company owes to someone else. Liabilities for a business may be long-term loans used to fund business operations or money owed to suppliers. If a company has an obligation to pay someone, it is a liability. In simple words, most people have liabilities in their day-to-day lives, like car loan, house loan, or credit card bills. These are all the liabilities. In the same way, even in business, we take loans from banks for business loans, or we might purchase some goods from our supplier and he might give us credit period. After certain days, we need to pay those liabilities to our customer, to our suppliers. So this is also a liability because we owe some money to others. And some of the examples of liabilities are accounts payable. Accounts payable means we have purchased some of the goods from suppliers and we need to pay them after the credit period. That is accounts payable. And loans. Whatever the loans which we take from outsiders, also a liability. Loan is also a liability. And tax payables. The taxes which are to be paid to the government, income tax, or any TDS which we have deducted from the services which we have took from the outsiders. So these are all the tax payables because that money doesn't belong to our business organization. That belongs to the government and we need to pay it. So this is called as liabilities. And the next concept is expenses. Let us understand expenses. Expenses are the money spent by a business in an effort to generate revenue. Expenses are the cost of doing business, which in turn helps to generate profit. Let us take some examples to understand expenses like office rent, electricity bills, phone bills, internet bills, fuel expenses. These are all the expenses. So office rent is an expense because that needs to be paid every month. If the office building is ours, there is no need of paying rent to others. But if we take office on rent, we need to pay some rent to the landlord, to the owner of the building. And electricity bills. Every month we need to pay electricity bill because we are using the electricity from government. And the next is phone bills. So phone bill should be paid every month because we are using telecommunications. And internet bills. Because we use internet, we need to pay internet bill also. In the same way, fuel expenses. The fuel expenses means whenever we commute any goods from our business organization to customers, that means whenever we sell the goods to customers, we need to deliver those goods to the customer's place. At that time, we need petrol and diesel for our vehicles. So those expenses will come under fuel expenses. And this is called as expenses. And the next term is incomes. Let us understand incomes now. Income is the total amount of money generated by the sale of goods or services related to the company's primary operations. Income accounts contain the receipts of revenue that a company receives through their business transactions. For example, when a company earns revenue from business activities or from non-business activities are called as incomes, like interest revenue, The income that a business earns from investment bank deposits is known as interest revenue. Or whenever we sell the goods, we receive some amount of money on the goods sales. This is called as income. In the same way, whenever we sell any asset, when we receive any profit more than the asset value, that becomes an income. So these are all called as income. Let us understand this income with an examples. Like sale of goods, whenever we sell any goods, that becomes an income. And interest on investment, whenever we invest any money in some shares or in any other companies, or we have invested our money in bank deposit, we receive an interest on the investment. So this interest is called as income. And gain on asset sale, in the same way, whenever we sell any asset, whatever the income which we receive more than the value of asset, that becomes a gain on asset sale, that becomes an income. So this is called as account types: assets, liabilities, expenses, and incomes. So this is all our account types. And the next is rules of accounting. So now we will understand the rules of accounting. For example, there are four roads. There is a junction. In between the junction, there is a traffic light. The top, bottom, left, and right. So, whenever we come towards the road, towards the junction from any side, for example, we are coming from the bottom, we will decrease the speed. Whenever we cross this junction, we increase the speed, right? In the same way, whenever we are coming from the top towards the junction, we decrease the speed. And as soon as we cross the junction, we increase the speed. We are coming from the left hand side towards the junction, so we need to decrease the speed. As soon as we cross the junction, we can increase the speed. In the same way, we need to decrease the speed while we are coming towards the junction, and we increase the speed as soon as we cross the junction. Whenever we cross the junction, we increase the speed, but whenever we coming towards the junction, we decrease the speed. So now let us apply this concept in our accounting, rules of accounting. Keep assets in the top and liabilities in the bottom, left side expenses and right side incomes. These four roads reaches these destinations. The top road reaches assets destination, the bottom road reaches liabilities destination, and the left road reaches the expenses destination, and the right hand side road reaches the incomes destination. And now we will apply the debit and credit concept to these four account types. Assume that debit will be the left side of the assets and liabilities, and the credit will be the right side of the assets and liabilities. Debit will be in the bottom of expenses and incomes road, and credit will be in the top for expenses and incomes road. And this is how it looks if we combine debit and credit for assets and liabilities and expenses and incomes. So debit will be the left side for assets and liabilities, and credit will be the right side of the assets and liabilities. And for expenses and incomes, credit side will be in the top and debit will be in the bottom for expenses and incomes. So we need to remember these two things only. So now we will apply the rules of accounting. So whenever the asset is increased, we need to debit it. So whenever the asset is decreased, we need to credit it. And in the same way, when liabilities are increasing, we need to credit it. In the same way, whenever liabilities are decreasing, we need to debit it. Whenever the expenses is increasing, we need to debit, and when expenses are decreased, we need to credit. And whenever incomes are increasing, credit it, and whenever incomes are decreasing, debit it. If we combine debit and credit rules for the all account types, this is how it looks. So now we will understand this with an example. For example, we have purchased an asset, that is building. So asset is increasing. Whenever asset is increasing, we need to debit it. In the same way, we have purchased a car, we need to debit it because car is an asset. For example, we have received some money from our customers, so debit it because that is an asset. In the same way, liabilities also. Whenever we took a loan from the bank, that means liability has been increased, so credit it. In the same way, we have purchased some of the goods from supplier, that means liability has increased, so credit it. In the same way, expenses. For example, we have incurred some expense for fuel, that means expense is increased, so debit it. So whenever we pay the rent, that means expense is increasing, so debit it. In the same way, electricity also. Whenever we incur electricity expense, we are paying the electricity bill for each and every month. That means expense is increasing every month, so debit it. So debit the electricity expenses. Incomes. For example, we are receiving some interest on investment. That means income is increasing. So whenever income increases, we need to credit it. So interest on investment will get credited. We have sold some goods, so we are receiving some income. So that means income is increasing. So credit it. Credit the income. In the same way, we have sold the asset. We are receiving some amount as an income. So whenever income is increasing, we need to credit it. Asset sale is an income, so I am crediting the asset sale income. So now we will see the decreasing. Whenever the asset is decreasing, we need to credit it. For example, assume that we are selling off the building. That means asset is decreasing. So whenever the asset is decreasing, we need to credit it. We have credited. And another example, whenever we sell off our any vehicles or car, that means asset is decreasing. We need to credit it. In the same way, whenever the cash is going out from our business, cash is an asset. So asset decreasing means we need to credit it. Credit the cash. And the next is liability. For example, we have paid off our loan. The loan which we have took, we have paid it off. We have took 2 lakhs loan. After 2 years, we have paid back the loan. That means liability is getting decreased. So whenever the liability is getting decreased, we need to debit it. And whenever we purchase the goods from supplier for credit, it means liability is increased. Whenever we pay back for the goods which we have purchased, that means liability is getting decreased. In the same way, if the expense is getting decreased, credit it. In the same way, all the expenses which are getting decreased, if it is getting decreased, credit it. For example, income is getting decreased, so debit it. So this is all about the golden rules of accounting. Now, so in this video, we have understood the account type: assets, liabilities, expenses, and incomes. And also we have understood debit for assets and liabilities and credit for assets and liabilities, and debit and credit for incomes and expenses also.